Hello, my name's Craig Earl, I'm Senior Market Analyst at Oanda. Today we're going to talk about the Euro versus the US dollar. Now, quite clearly, this chart shows you everything you need to know. We are on a constant downtrend here. We're effectively seeing here is a weak currency against a resilient currency. For most of towards the end of last year and early this year, people were calling the end of the dollar bull run. And as you can see with the US dollar, that's not entirely inaccurate. We have been topping, we're failing to make new highs, but we've also not seen that sell off either. So there has been a lot of resilience. And coming up against the US dollar, that is particularly prevalent because the euro is seeing some extreme weakness right now, whether that be domestically with a recession in Italy, a near recession in Germany, weak manufacturing data. It doesn't matter. Wherever you look with the euro right now, there seems to be pockets of weakness. And that weakness is obviously causing uncertainty around the currency. And that's been aided further by the moves of the central bank. The European Central Bank has moved back its expectations for a rate hike this year until next year. Some would even suggest the year after, TLTROs, and it may not even stop there. Now, the Federal Reserve has also become more dovish, in fact, much more dovish than many expected, calling an end to rate hikes this year and putting in place only one for next year. And again, this could change, but people are viewing the situation in Europe right now with the growth situation on top of the central bank and viewing this as worse. So what we've got is a situation whereby we've got three very clear levels on the chart. We have 113, which is long-term support in the area around 113. We've seen that be support on numerous occasions. Now that's been broken over the last 24 hours or so. So now all eyes really are on 112. 112 and the area around it again has been support more recently. I think 113 was the more significant support, to be honest, because of the amount of times it's been tested and held. But there have been a couple of occasions, as you can see on that chart, where 112, where we have come back to these 112 levels before finding a little bit of support and moving higher. Clearly, this is not a straightforward chart where you've got one area of support here, but it's quite clear that you've got this consolidation of support around these levels. If we see a break of this could be the catalyst for a more significant move to the downside. And again, to the downside, we've got these kind of 111.50, 111s, 110. Obviously, it's the big psychological level and the one people will be closely watching. But again, let's see how momentum fares around these kind of 112 levels, because what we've seen previously is it just has failed to pick up any momentum despite the breakouts, which from a technical analysis standpoint is a bit of a nightmare scenario. So the upside 114 remains the key level for two reasons. One, it's the area where we've got the most recent high. For two, we've got this long series of downwards of lower highs. This is the main signal really that we've got a bearish trend, a series of lower highs and lower lows. But we've got a long series of that at this moment in time. And if we break through 114, we not only take out the previous high, we also take out that downward trend line as well. And again, that gives us that'll put a lot of pressure on the key moving averages there, which is the 200 and 233, and that could again therefore be the catalyst to the upside and suggest the trend has changed. At this moment in time though, we're not seeing signs that that's happening. We've seen a break lower, we've got momentum with the move at this moment in time, and we've continued to see this series of lower highs and lower lows. So the dollar still has the potential to weaken over the course of this year, but when we're looking at it against the euro, it's looking more resilient than its European counterpart.